5 ways rich people make money with debt. Do you know that rich people make money with debt? Have you ever seen this? You must be thinking, how do the rich make money with debt? I will explain this in today's video, so stay tuned and watch this video until the end. Debt has gotten a bad rap in recent years, yet there are situations which taking on debt can be beneficial. In addition, taking on good debt is a great way to begin multiplying the impact of your cash and establish sources of passive income that may be used to build true wealth. Few would be able to buy a home or use their high income to begin constructing an empire if not for debt. Leverage is the primary strategy for effectively utilizing debt for favorable investment outcomes, as it permits the multiplication of initial investments by a factor of many. When do we use leverage and why? The term leverage refers to the practice of borrowing funds to increase one's return on investment. With the right amount of leverage, it's possible to earn money when you would have otherwise lost it. Here I'll explain what you could do to make your debt work for you rather than against you. In the meantime, learn to identify good debt from bad. What I mean will be made clearer in a moment. Loan interest may be deducted from your taxable income, and the proceeds from the appreciated asset can be used to pay down the loan. This is just an example of good debt. Investments made in real estate, stocks, and managed funds are just a few examples. Bad debt is used to finance the purchase of non-income producing or declining assets of services. Since there is no cash flow from the asset, the interest on the loan cannot be deducted. Credit card debt, if not paid in full within the introductory interest-free term, auto loans, if not paid off within the promotional time, and most mortgages, if not paid off within the promotional period, are all good examples. Let's move toward the 5 ways I have narrowed down for you to make money with debt. Number 1. Margin investing. When you trade on margin, it means that you are borrowing money from your financial firm to conduct trades. When you invest on margin, you can buy a greater dollar amount of shares than you have money for because you can borrow money to cover the difference. You could use leverage on your investments and open a margin account. For example, if you already had $50,000 in a regular brokerage account. You only need to put up the maximum of 50% of the stock's total cost when you use a margin account. You would have $50,000 cash and your broker would lend you the extra $50,000, bringing your total cash available to $100,000. You now have the purchasing power of $100,000 thanks to your investment of $50,000. You could buy $100,000 worth of stock with this money. If the price of the stock rises, you'll be able to repay the loan and keep the profit from the investment. The drawback is that a margin call may be placed on your account by your brokerage business if the value of the stock in your account drops below a specific threshold. If you don't have the cash on hand to cover a margin call, your broker will be forced to sell all of your shares of stock, resulting in a loss for you. Number 2. Leveraged ETFs. Leveraging exchange-traded funds, often known as leveraged ETFs, are a type of marketable product that amplifies the profits of an underlying index by using various financial derivatives as debt. As a result, traders and investors can increase their profits by betting on the rise or fall of specific index. Leveraged exchange-traded funds, ETFs, are offered by fund providers such as ProShares. These ETFs enable investors to increase their gains by a factor of somewhere between 200 and 300% of their total. Using these funds, you'll be able to invest in particular stocks, bonds, commodities, or sectors of the economy. The huge potential of profit made available by leveraged exchange-traded funds makes them appealing. You can generate gains with leveraged ETFs during market booms, which are the stuff that most investors can only dream about. The difficulty with leveraged ETFs is that their main benefit can also become their downfall. When used improperly, leveraged ETFs can wipe out an investor's whole investment in a matter of days. Number 3. Hedge funds. A hedge fund's goal is to do better than other pooled investment vehicles by using advanced trading, portfolio building, and risk management strategies. Hedge funds are among the most prominent consumers of leverage in the financial industry. They gain notoriety for their ability to generate abnormal profits by utilizing leverage. A lot of hedge funds use as much as 10 times their entire assets as leverage. Through the use of leverage, multimillionaire investors have been turned into billionaires by billionaire managers of hedge funds. If, on the other hand, the investment thesis of the fund management is incorrect, this might fall in the hedge fund, which would result in the loss of capital for all investors. The amount of debt held by some hedge funds, such as the one managed by Long-Term Capital Management (LTCM), which required a rescue, was as high as 30 times the fund's assets. Number 4. Short selling. Short selling is a method for investing or trading that speculates on a drop in the price of a stock. Because of the complexity of the approach, it is recommended that only seasoned traders and investors try their hand at it. Have you ever seen on TV a financial program where the host suggested that you should short the market? The practice of borrowing shares from another investor and then selling those shares in the expectation that their value will continue to fall is known as short selling. People who want to bet against a certain investment often use this type of bet. Short sellers have amassed enormous fortunes by accurately predicting when stock values will fall. One problem with short selling is that there is no limit on how much money can be lost. This means that people who sell short portions risk losing a lot of money than they put in at first. Number 5. Forex trading. Traders in the foreign exchange market can exert influence over significant quantities of currencies with only a small sum of capital. Currency investors can obtain a 100-to-1 leverage on their accounts. One of the many benefits of forex trading is that even a small initial investment can be turned into a large amount in a very short amount of time. George Soros is famously referred to as the guy who ruined the Bank of England because he made a profit of $1 billion by trading against the pound. On the other hand, currency trading carries the risk of completely emptying a trader's bank account in a short amount of time. Don't get into these debts. There are a wide variety of unfavorable and undesirable forms of debt, which include consumer debt, which is defined as debt used to purchase non-appreciating consumable goods. Second, speculative loans are defined as money that is borrowed to make speculative investments. The third type is a margin loan. Borrowing money based on the potential future growth of your current portfolio is called a margin loan. However, with the appropriate set of circumstances and the advice of an experienced financial advisor, even these debts may be utilized to achieve tax benefits, give chances for cash flow planning, or build up lucrative cashback incentives. However, the majority of the time, these sorts of loans are riskier, and they are not used to purchase assets that reliably grow wealth. If handled and managed properly, debt can allow consumers to make investments they wouldn't be able to afford otherwise, boosting their returns greatly. This may go against popular thinking, as debt is often considered a drag on an individual's finances. Investing includes taking on risks, one of which is the possibility of losing some or all your initial capital. There are benefits as well as drawbacks associated with using debt to generate wealth. Keep in mind that debt can magnify both earnings and losses, despite its positive or negative implications. You must analyze the loan's terms, including the interest rates, estimated payback obligations, and actual costs throughout the loan before you commit to it. You should be very careful of the possibility of losing could put any of your other money at risk. It's time to end the video here. I'll be back with more great content soon, so subscribe to my channel. But before that, give a thumbs up to this video and share it with others too. If you've had experience with making money using debt, then do let us know in the comments section below.